this person's from a local bank, this person's all cash, and this person has to sell their house first before they can buy your house. So with a cash out refinance, you can do whatever you want with the money, as long as you've got the equity there. But I always have the conversation with people, does that make sense? Right now, if you keep doing what you're doing on your car loan, you'll be paid off in 5 years. If we wrap that into your mortgage because you're drowning in debt, you're technically taking that $30,000. Instead of being done in 5 years, you're putting it on a 30-year loan.
Right.
So it's costing you a lot more. So once you've got all the documents to me, I've pulled your credit, then I run it through underwriting, and underwriting will ultimately say green light go, or can't get you approved. So my name is Tony Trahan. I'm a mortgage lender with PyraMax Bank, and I help people get their dream of homeownership.
How long have you been doing it?
6 years.
Okay.
6 years, 3 different banks, and I've been with PyraMax for a little over a year.
And what kind of inspired you to get into the industry?
It kind of morphed into it. I started off as a financial advisor with Northwestern Mutual.
Okay.
Did that for a few years. Then I went to State Farm in the insurance industry for a few years. And then I started doing consumer loans with a credit union. So I was doing their boats, RVs, ATVs, cars. And the next promotion or progression with that credit union, if you were doing their car loans, the promotion was mortgage loans.
Oh.
So it's a bigger loan amount, a lot more involved. So they moved me to mortgages. So I did that with them for a little over a year. And then that was a great stepping stone and segue. And I found out that I loved the industry. So I just kept going with it.
Gotcha. Awesome. So you have so much experience in the loan world.
Yeah, a little bit of everything.
Yeah. Boats, cars. What's the most expensive thing that you've helped get mortgaged?
A house.
Okay.
A new construction house where it's almost $2 million.
Jeez.
And that's, they start from the ground up. You go to a builder and you say, this is what I want my house to look like. This is how many bedrooms I would need. Or I'm looking to entertain and I want a pool. And so you work with the builder hand in hand, and they can basically design your dream home, and then you got to pay for it. So then you come to me and say, hey, here's my design plans. Here's how much it's going to cost me. Can I get a loan? And that's where I come in.
Gotcha. So let's break down, because I know that would be like a separate loan, because that'd be like a construction loan.
Yep.
So let's kind of break down the loan options for people.
Yeah. So there's
A lot of them?
Over 50 of them. Yeah.
Okay.
So
main ones, we'll say then.
Main ones. So we've got WIDA. It's a first-time homebuyer program.
Okay.
A lot of people are first-time homebuyers, so they want to know about the first-time homebuyer programs. WIDA is a great program. It's Wisconsin-based. They have awesome interest rates compared to, the normal secondary market loans with Freddie and Fannie. And you can actually finance your down payment if you're within income limits. So it's a unique loan product that allows people that don't have a bunch of money saved up to get into a house with little to no money down.
Okay.
Beyond that, we can do new construction loans for people that are maybe looking, they're not seeing what they want to buy in the market. So they're like, you know what, maybe I want to build it now. So I can help them with that. We do lot loans. So if you can, right now, maybe you can just afford a lot.
Yeah.
And I want to build in the next few years. Get the lot now, I can help you with that. And then when you're ready to build in a few years, you've already got the lot. Now you just got to design it and build it.
Huh. Okay. So are they specific to like a lot, or could somebody just come and say like, hey, we need $100,000 for this, or is there like down payments for the lot?
Yep. So it'll be so the lot loan is 20% down.
Okay.
And we keep that in-house. We don't sell that loan, but we put it on a 30-year loan. Most other lots and land loan people in the industry, it's a 20-year loan.
Okay.
So we've got 30 years, so the payment's a little more stomachable for people that maybe they currently have a house payment or a rent payment, and they just want to get that lot for now. And then you can hold that lot if you were to build on it in the near future, I'd say 6 months or a year. I can use your down payment that you put for your lot towards the down payment requirement for building. So that's unique, where some people are like, hey, I can get gift money from parents, or I've got enough money saved to buy the lot. And then maybe now that they know the lot, now they're like, okay, well, now that I know how big it is and where I want to put my house, now I want to design my house. That process can take 2 months. It could take a year to design a house with a builder. So once you've got the design plans, I can say, okay, well, you just purchased this lot 6 months ago and you put a bunch of money down. We can use that because once a house is built on it, there's total value there. It's not just the lot, because there's a house. So there's value in that land. So if you put a bunch of money down for the land, I can use that towards your down payment requirement for your building. So with new construction, I can do little as 5% down payment.
Okay.
So
Up front, and then you roll over the down payment of the lot.
It's all in one loan, correct. So that we've got equity on that lot. So the total loan to value, now that there's a house on it, it's worth more. So we can use the down payment for your lot on your build.
So would the lot loan be refinanced then into the rate of the house?
It's all in one. Yep.
Gotcha.
Yep.
So is that how all refinances work? I guess I don't know how they work too much. Is that you'd use the new big loan to pay off all the small loans and combine them and consolidate them into one?
Yep. So whenever you refinance, you don't necessarily have to pay like let's say you've got credit cards out there, or car loans or student loans. Whenever you refinance your mortgage, you have options. You can either consolidate all those payments into one on your mortgage if you have the equity in your house, or you can just say, hey, you know what, Tony, I know interest rates are lower than what I currently have on my loan. I just want to refinance to get a better interest rate.
Yeah.
You can do that too.
Okay.
The unique thing with refinances is you can include the costs of doing the refinance in the loan.
Explain that better.
So you wouldn't so a normal refi, so let's say closing costs, they're normally $2,000.
Okay.
And then you've got to establish an escrow account, which is $1,000, $2,000 as well. So there's costs involved with doing a loan.
Yeah.
On a purchase, you have all those up front, and you have to pay for them up front.
Okay.
It's part of your closing costs. On a refinance, you can include those closing costs in the loan. So you're technically financing it on your next 30-year loan, but it's little to no money out of your pocket.
Right.
So if you need an appraisal, it's going to cost you maybe $450. That's an out-of-pocket cost, but everything else can be put into the loan.
Interesting. And is there something that you could buy a house from somebody and roll their loan into yours, where you could keep their rate and loan and stuff?
So that's an assumable mortgage.
Okay.
Most mortgages are not assumable. So if you currently have a property or someone has a property and you want to get their 3% rate, they would have to look at their mortgage documents when they closed to find out if their interest or their loan note is assumable.
Okay.
I would say 99% of the time they are not.
Gotcha.
So then when you go to buy that house, you're going to fill out what's called an offer to purchase. And it's basically saying, hey, I know your house is worth $300. I'll pay you $310. And then you would go through someone like me for the financing.
Gotcha.
And then we would pay them. You would have a new loan under your name with me, because most loans you're not going to be able to assume that seller's mortgage.
Interesting. Because I feel like I see a lot of people on TikTok boasting about assumable loans where they're just taking over somebody's loans.
It's not popular.
Interesting. Yeah, because they were saying that they wouldn't have to have a down payment. You could just take over their loan and just keep it going. That's so funny. That's not popular.
Yeah, no, it's not.
Interesting.
Yeah.
What is the most popular loan if you're not a first-time home buyer?
I'd call it a step-up loan. Okay. So that would be you bought your first house. It was a starter home. Maybe you did some renovations to it. And now you've got a family or you got kids and you want to be in a different school district. So you're ready to move up. So maybe you bought that first house for $250. You did some renovations to it and now it's worth $350. Now you can take the equity in that house when you sell it and go buy your next house, your step-up house. So that would just be a normal conventional loan, 30-year term. And we have been with PyraMax Bank. We also have our in-house loans, our portfolio loans, where we can make our own rules because we keep the money in-house. But we also have the broker channel. So I have access to the broker channel. So any of your VA loans or USDA or DSCR, which is an investment loan or a bank statement loan. I have access to every loan program out there. So depending on what your situation is, what you're trying to do with the property, if you want to live in it or you want to rent it out, we've got options.
There's different options for each one.
Yep.
Okay. Gotcha. And I didn't know, I did a little bit of research a couple weeks ago because I was just curious. I didn't know that there was any secondary loan market that banks sell off the note to somebody else. Yep. Can you explain that? Because I feel like a lot of people have no idea what that is.
Yeah, they have no idea. Yeah. So whenever you get a loan, at least with PyraMax Bank, so we have two options. I can service released, where that means we release the servicing. After we close your loan, a month or two later, you're going to get a letter in the mail saying, hey, your loan has been sold and bought by X investor.
Okay.
Or servicing retained means if you don't want to get that letter in a month after you close and you always want to call me with questions, you can call me. That's servicing retained. The two options come with different interest rates. If it's servicing released, you can get a little bit of a better interest rate typically because we aren't guaranteeing holding your hand for the next 30 years if you have questions. If it's service retained because you never want to get that letter that your loan's been sold, the interest rate's a little bit higher, typically 0.5%. But it's situational. But that loan doesn't get sold, stays with us, we service it.
Gotcha.
So, well, I shouldn't say that. We would service the loan, it still couldn't get sold, but we would service it.
Okay. And what would be the difference between those two loans? Like, why would you guys want to keep one? Why would you want to sell it?
So the ones that we keep are typically because either the property or the client didn't fit in a box. So like our new construction, you can't sell a loan if the house isn't built yet.
Gotcha.
So we keep that on the books with new construction. It's interest-only payments while the house is being built.
Okay.
Because you probably have other housing payments where you're currently living. So it's tough for some people to balance 2 full mortgage payments.
Okay.
So it's interest-only while the house is being built. Once it's built, now it has value, it's livable. That's when we can either keep it on the books or we can modify it and sell it.
Gotcha.
So
and
you have options.
Would you guys sell it to get more cash on hand? Is that why banks do that?
Correct. Yep.
Okay.
Because money can go really quick if you've got a bunch of people buying $600,000 houses.
Right.
Like money on hand gets spent really quickly.
Okay.
So the name of the game is book the loan and then sell it.
And who are those investors? Just normal people, or are they big hedge funds and stuff?
Yeah, big hedge funds, big banks. I don't know. It kind of depends. So whenever we're looking at interest rates, I ask the questions to my clients, what's important to you? Do you always want to have to deal with me, or are you okay with getting your loan sold? Is interest rate important to you? Like local servicing? And, if they don't know, I'll explain it to them. And then they can say, like, you know what? I just want the best interest rate, Tony.
Yeah.
Okay, perfect. Your loan's probably going to be sold. But we can get you a better interest rate that way.
Right.
Whatever gets me the lowest interest rate.
Gotcha.
Okay, understood. So
if they wanted to go refinance, who would they reach out to then? Once it's sold, is there like a point of contact?
Always call me.
Really?
Yep.
Even if you guys aren't servicing it or anything anymore?
Yep. So
really?
I can refinance any loan.
Okay.
So it doesn't have to be originally booked with me. If you originally got your loan with another local bank or a credit union or a broker shop, I can always refinance it. It doesn't have to go back to the same person that you originally worked with.
Huh. Interesting. So we'll leave your stuff in the description.
Link below.
Yeah, link below. So would those refinances, those would become like a good loan, and then you guys would sell those right away then too?
Probably, yeah.
Really?
Because most people are refinancing because they want a better interest rate.
Right.
So the way to get them the best interest rate would probably be to sell the loan.
Huh.
Now, it's situational. It depends on what your credit score is. Is the property unique? Like, is it... I've had ones where they're literally built into a hill and there's no roof. The roof is dirt and grass. Like think of like the Hobbit house. Like, I've literally... Like, no investor is going to buy that loan because that's a unique property.
Okay.
Other unique properties are where they've got a lot of land, where like maybe it's 15 acres. We'd like to keep it under 10 acres for land size. Otherwise, it opens up a different umbrella. If you have more land than that, it could be zoned agriculture. So it has to be zoned residential. Or some agriculture, it's like, well, we rent out the farmland. So unique properties like that where we don't have an outlet for it, we're going to keep it on the books because we believe in the borrower. They're a strong borrower. The loan makes sense, but we just don't have an outlet for it. So that's where we would keep it in-house.
Right. Gotcha. So those more unique properties are ones that would be a higher interest rate, and you guys would keep those in-house?
Typically, yeah, we're going to offset the risk with a higher interest rate because interest rates are all based on risk. How risky is that loan? What are the odds that person's going to default on it and not pay us our money back? So the factors that go into the interest rate are how much money you're putting down. If you're trying to do a low money down loan, let's say life happens and now you can't afford it and you stop paying it, we have to get our money back. So we've got to sell that house and hope that we can get top dollar for it.
Right.
Now, no one ever wants to foreclose or, take over someone's mortgage. The bank does. We're not in the business to take people's houses from them. So putting them in a good position as far as what's that monthly payment look like, and just making sure that they're not like house poor.
Right.
But I lost my train of thought. Where was I going with that?
That's all right. We'll move on to a new topic. Should somebody like a buyer know about the secondary market, or do you think it's really not that important to them?
It's not that important. When you're a first-time home buyer, or any buyer for that matter, they want to find the house, right? They're not too worried about the details. They're looking for the house that makes sense for their family. Maybe it's in a school district they want, it's in a bigger yard that they're looking for, or in my personal scenario, the house that we ended up buying was in the same neighborhood that I grew up in.
Okay.
Right next door to where I grew up.
Oh, wow.
So my mom's still there.
Really?
So at that point, I didn't care what the house looked like because the location made sense to me.
Yeah.
So that's why we ended up completely gutting the place and redoing it. But the location made sense. So at that point, I wasn't worried about what loan I was going to get because I knew the location and that house just made sense to me.
Right. So for like you did a big flip, or you gutted the inside, didn't you? Or big resurfacing.
Yep.
Did you have to take out a different loan for that? Is there specific loans for doing that type of stuff?
So luckily we had another property that we had done a lot of renovations on, and there was equity in that house. Okay. So we did a HELOC on that house because it was our primary residence. So that gave us a bunch of cash so that we could renovate the property.
Okay, walk through that, please.
So that's a great. So a HELOC is a home equity line of credit.
Okay.
The easiest way to think of that is it's like a credit card without the credit card.
Okay.
So with a credit card, you're spending Capital One's money.
Mm-hmm.
With a home equity line of credit, you're tapping into the equity in your house.
Okay.
So let's say you bought a house from a family friend and they cut you a really good deal. Mm-hmm. Let's say they said, "No, we grew up with Johnny. We're going to take off $50,000 because we know him."
Mm-hmm.
And let's say it needed some updates, and you did some updates to it. So now you've got a whole bunch of equity there because the house is worth way more and you got a really good deal on it. That's when you can tap in to get one of these home equity line of credits.
Okay.
We offer those at PyraMax Bank. But it's basically you have access to it whenever you need it.
Okay.
So when you look at your bank account on your app, you would see checking, savings, and HELOC. You would see literally a line item. You can transfer money instantly from the HELOC to your checking account.
Really?
Correct. So and people shouldn't use this for like fun money. I like to think of it like an emergency net. It's there in case life happens and your HVAC, I don't know, your furnace goes out and now you need $8,000.
Mm-hmm.
You're putting that money back into the house. So the house is going to increase in value. So that would make sense, but I wouldn't recommend pulling out a HELOC if you just want to go on vacation.
Right. Because
just like a credit card, so if you don't use it, there's no monthly payment. If you pull money from it, you've got a monthly payment.
To pay back what you pulled?
Correct, yep.
Okay, and with interest?
Correct. Yeah. Interest rates, so right now we've got a special at 6.99% interest for the first.
For the HELOC?
Correct.
Okay.
So it's not free money.
Yeah.
So don't utilize it like it's free money, but like if someone wants to, let's say the same scenario, they've got a bunch of equity in the house, they open up a HELOC, and now they want to finish the basement.
Mm-hmm.
Finishing the basement might be $10,000, it might be $100,000, depending on how fancy you get. But you don't have that on hand.
Right.
You can tap into the equity on that HELOC to pay the contractors or go to Menards and do it yourself.
Mm-hmm.
The opportunity then, once the basement is done, is you can, if the interest rates are now more advantageous, you can also refinance to consolidate. You pay off that HELOC balance and put it into your first mortgage. Because all the costs associated on that HELOC, all the balance on it is because you put it into your house and made your house worth more.
Yeah.
So instead of doing interest-only payments on that HELOC and kind of carrying that debt and just having
6% too.
Correct. That's 7%. Instead of just carrying that debt, you can then consolidate it and have like a finish line on that.
Gotcha.
So a lot of people are like, well, my house is worth more now. Maybe they didn't put a lot of money down, so they might have what's called PMI, mortgage insurance.
Yep. Mm-hmm.
If they've done a bunch of renovations and now the house is worth more, the refinance can be advantageous for a few reasons. Reason A is get a better interest rate.
Mm-hmm.
Reason 2 is now you can consolidate your debt and put it on there.
Okay.
So you pay off the HELOC balance and now you just have one mortgage payment, but the house is worth a bunch more.
Gotcha.
So, and I walk my clients through that, but let's say you bought an interest rate 8 months ago and you've got a 8% interest rate because that's where rates were at a year ago.
Uh-huh.
And let's say in the next year to 18 months, rates come down to 5.5%.
Mm-hmm.
We can look at when you go to refinance, a lot of people might just refinance and put their loan back on a 30-year loan.
Okay.
So now you've reset your timetable.
Yeah.
So let's say you pay it down for 3 years or do renovations and then you refinance. If you put it on a 30-year, you're kind of doing yourself a disservice because now you put that back on a 30-year loan.
Right.
So if you can save 2% on your interest rate with a refinance just because of how the market is doing, I always say, hey, let's look at what a 20-year loan would cost you or a 15-year loan would cost you. Interest rates are dependent on risk, what I said earlier. Another factor to how much equity you have in the house and how good your credit score is how long is that term. If we're going to give someone a 30-year mortgage, that's a lot of opportunity for something to happen in their life where they can't make the payments. So the shorter the term on the mortgage, the better the interest rate.
Okay.
Because it's less risky.
Yeah.
We're not signing up to hold your hand for the next 30 years. We're signing up to hold your hand for the next 15.
Gotcha.
So it's not as risky, so you get a little bit of a better interest rate.
Okay.
So all those factors combined, if someone rates are now lower than what they currently have, if you can look at a refinance for them, maybe we can match their payment or have it be a little more than they're currently paying, but be on a 10-year shorter loan.
Right. Yeah, you're cutting the finish line a couple miles behind.
You're saving hundreds of thousands of dollars.
Yeah.
So whenever you're doing a mortgage loan, you get what's called an amortization schedule, and that breaks down how much of your payment is going towards principal and how much of your payment is going towards interest. With mortgages, the interest is very front heavy.
Okay.
You're not going to see a lot of traction on that loan for the first 5 years.
Really?
Yeah.
Okay.
So every time you refinance, you're resetting that timetable, paying a lot more interest for the first 5 years. Correct. So if we can shorten that term from a 30-year to a 20-year, I mean, man, it'll save you hundreds of thousands of dollars.
Yeah.
So with that amortization schedule, the thing with that is it's tricky. So if you were to make, and that just goes off of your minimum monthly payment, your principal and interest, that's what that calculation is off of.
Okay.
So let's say you round up or you get a bonus and you put an extra $5,000 on your mortgage loan. That amortization schedule that you were following is now wrong. It's inaccurate because it's based off of the exact payment, minimum monthly payment. So you can go online and redo an amortization schedule or call me and let me know. Say, hey, Tony, if I inherited $40,000. If I put that on my loan, how much money is that going to save me?
Yeah.
Does it make sense to refinance, or can we just modify your mortgage and make it a lower monthly payment because you did a huge lump sum on it?
Okay.
What options do we have to save you the most amount of interest?
Yeah.
So.
Gotcha. And for those, I'm trying to think of if you did like a 15-year instead of a 30, it would be less risky for you guys because you're borrowing out money for a less term, but it's also bigger payments for somebody to pay.
Correct.
So do you have to decide, like, if their credit's looking good, if their income looking good, that they could go to a 15-year thing instead of a 30-year, or could anybody do a 15-year?
Anybody can do it. It just depends on your monthly budget and if you're comfortable with it.
Really?
One factor that we look at is called your debt to income ratio.
Okay.
Your DTI. We want to keep that below 45%, hopefully. So 45% debt ratio is 45% of your fixed expenses, including the proposed mortgage payment, and compared to your gross income.
Okay.
Now, what a lot of people don't, they come to me and they say, Tony, what's my max budget? We're looking at someone's gross income when I'm giving them a max budget, not their net. So if they're doing 10% to their retirement accounts, if they've got health insurance before they get their tax bill, there's all these deductions. I'm going off of that big shiny number up top.
Yeah.
Not what you actually see in your bank account. So it can put a lot of people in a tight position if they do max out their budget, because I can get you approved for probably a lot more than you're willing to pay monthly.
Yeah.
And having, just that thorough conversation of, okay, right now we don't have kids or kids that are in daycare. We don't have car payments. What happens when we do?
Yeah.
We can afford this house payment now, but in a year from now, we've got $1,000 or $2,000 a month in daycare costs.
Right.
We've got a $700 car payment. Now can we afford life?
Yeah.
And groceries and insurance and,
it adds up. Yeah.
It adds up. So I have that thorough conversation with all my clients. It's like, hey, okay, here's what I can probably get you approved for. Are you comfortable with that payment? Does that payment give you heartburn? Let's think in 3 years from now, can you still swing that payment if you've got kids in daycare?
Right.
So just having that conversation and really opening up people's eyes, because they want the most, the best house they can afford.
Yeah.
But it's like, hey, do you really want that payment?
Yeah. Can you afford it in the next couple of years? Right.
Correct. Yeah. So otherwise, then you get people that have to downsize, or they can't afford to get a new car because they've got a big mortgage payment.
Right.
So it's like, let's take a holistic approach and look at the big picture here. Is this something that you're comfortable with now? And do you think you'll be comfortable with it in 3 years?
Mm-hmm. So. Right. So going back to the HELOC, can you access that right when you buy the house? Or say, would you have to, so we'll give this as an example, like you bought the house for like $200,000 and then you did some fixing up and now you got it appraised at $400K. Mm-hmm. So you'd have that $200K that you could pull out on credit.
Yep. So we'd like to keep it, the HELOC at 80% loan to value. That's where you get the most advantageous interest rate.
Okay.
HELOC. So 80% on 400 would be, what is that, 320?
Got the calculator on one.
Got the calculator ready to go. Yeah, 320. Look at
okay.
you go.
Yeah, look at you go, dang.
All right, so then let's say you owe 200. Mm-hmm. We can bring you up to 320 for a total loan to value. So we can get you a HELOC for $120,000.
Okay.
So it's for that difference there because we want to keep your total balance on that property at 80% of what it's worth.
Right.
So you can have access to $120,000.
Gotcha.
And then let's say you need to put a new roof on it. It's going to be $23,000. You just go on your HELOC on your app, transfer $23,000 from your HELOC to your checking account, and you instantly have it access to you.
Huh. Interesting. So do you have to set up that HELOC, or is it just automatically there?
No, you have to set it up.
Okay.
The process is probably 3 weeks.
Okay.
With a bank, and it's going to require an appraisal. They're going to want to go out there and make sure that the value of it is what you think it is because now you've done renovations.
Right.
Because they're going to say, well, you just bought the house, 10 months ago or a year ago. You paid $200 for it. Why is it worth $400?
Yeah.
So they're going to request an appraisal, and that would be, probably $450 where you can go out there and the appraiser would say, yeah, they completely renovated the house. It's worth $400,000 now. To verify that value of the property, then we go through a few other processes and we get you the HELOC.
Huh. Interesting. Is it pretty common?
Yeah.
Or really people use it a lot?
Yeah. And the reason why they become so popular is because a lot of people have a bunch of equity now with the housing market going crazy.
Okay.
They might have paid $300 for a house, and now the house just in the last 6 years, it could be worth $500.
Yeah.
Just because of appreciation and, the housing market going crazy. So when an appraiser comes out, they're going to be looking at comps. A comp is a comparable property.
Yep.
So if the comps that they're looking at are all homes that recently sold for $450,000 or $500,000 because the housing market is nuts and that's just the value of the property now, you've got comparables to support the value of your property. So now your value is higher and then you can get the HELOC.
Gotcha. What are other options like a HELOC, like a cash out refinance? Would that be a similar thing where you could get some money out?
Yep. So cash out refinance is going to be something that you would work with me. So if you're looking for a HELOC, I've got a guy, Cameron, on my team. He takes care of all my HELOCs.
Gotcha.
So if you call me, maybe we did your loan 5 years ago and say, hey, Tony, I did a bunch of renovations. My house is worth more. I want a HELOC. Great. Let me shoot you over to Cameron. Cameron's going to take care of you. Cameron does all my HELOCs. But if you do a cash out refinance, that's something what you do with me. A HELOC is a second mortgage. It's separate from your first mortgage.
Right, so you're taking out a second loan.
Correct.
Kind of thing, yeah.
If you refinance, you're only going to have one loan.
Right.
And let's say you want to do renovations, but I can get you $40,000 out or whatever the equity is that you've got. And instead of having an interest-only payment, because HELOCs have a draw period.
Okay.
So a draw period is where you have access to this HELOC and you only have payments if you use it. You have like a 5-year draw period. So you can pull from that for 5 years.
Okay.
Then we put it on a repayment period. So then it's like a 20-year repayment. So it's like a 20-year loan.
Okay. Gotcha.
So that's
at 6%.
Correct. It's not
7%.
Yeah, it's not open forever.
Right.
We give it, for 5 years. And then if you want another one, we can get you another one, but it's a new process.
Gotcha.
A new HELOC. So we'd close that one and get you another one.
And so with the HELOC, when you take out money, would that be a monthly payment in the future? Would it just be like a lump sum that just keeps compounding that 7% APY?
So, yeah, it's a monthly payment. If you want to pay more than that, you've got your interest only, but then you would have to pay some principal on it to get the balance reduced.
Gotcha. And that's 20-year expiration date?
Correct, yep.
Okay.
So, and we've had people where they'll get a HELOC because it makes sense. They have a bunch of equity and they need to renovate a whole house. Now they've got a monster HELOC where they owe $150,000 on this, and the repayment period's coming. $150,000 on a 20-year loan is going to be a lot more expensive.
Right.
So if we can refinance that, we'd basically pay it off and put it into a first mortgage with them.
Okay. So is that where the cash out refinance could come into play,
Correct.
where they could use that cash to do the
Pay off.
modifications instead, or to pay off the HELOC?
Correct. Yep. And you can do it. I mean, you can do what you want with the equity in your house if you want to. Like I've had people do cash out refis to go buy rental property.
Right.
So they'll say, hey, you know what? I've got a bunch of equity in this house because I live here and I inherited it from family.
Mm-hmm.
It's paid off. They can do a cash out refinance on this property that's paid off.
Mm-hmm.
And then they're a cash buyer to go buy investment properties.
So how does the cash out work?
So
Let's get into more depth of it.
yeah, so it's a refinance. Whenever you add the cash out feature, the loan interest rate's going to be a little bit higher.
Okay.
A normal rate term refi, which means you're just refinancing to get a better rate or a more favorable term, so 30-year to 20-year, those interest rates are going to be a little better
Okay.
comparatively to cash out.
Okay.
If it's cash out, interest rate, going back to before, it's based on risk. So if we're increasing what you owe on this single property, a little more risky.
Right.
So the rate's a little higher.
Gotcha. So how it works is that you're gonna say you have 200 in equity in a house, 200K,
Mhm.
and then you want to do a cash out refi. You could pull out say 50K for another down payment on another place.
Yep.
But then you'd only have 150 in equity, so then your loan for that original property would get bigger.
A little, yep. So the payment's going to be higher, so you've got to factor that in as well because your payment's based on how much money you owe. So if you increase what you owe, payment's going to go up too.
Gotcha.
So when people are thinking about they want to be a cash buyer on their next investment property,
Mm-hmm.
I like to bring up the idea that property might cash flow on the numbers you're factoring in, but also factor in the extra cost and risk you've put on your primary residence.
Right.
Because that 50 grand came from somewhere, and it came from leveraging where you sleep at night.
Right.
So
Interesting.
So you've got to I can make $300 a month if I buy this rental property. It's like, okay, well, you increased your payment here by $250 a month.
Mm-hmm.
So you're really only netting $50 a month. Now you've got other tax reasons why that would make sense, but
Gotcha.
you got to look at the big picture.
Okay. So would that the cash out refinance would completely change the loan on the first house?
Correct. Yep. So then, so then you would owe $250 on your first mortgage. And then if we're looking at putting that on a 30-year, or maybe it might be more advantageous to do a 20-year loan, now you're really stepping up your monthly payment because not only are you shortening the term by 10 years, but you're also increasing what you're paying back.
Interesting. So a lot of people use it for investment properties, but you could use the cash for
You can use it for whatever, man. You can go on a trip to Spain. You can buy your dream car. You do whatever you want.
So it's a way to put some money in your bank account quick.
Correct.
Gotcha.
Comes at a cost.
Right. Yeah, it comes at a cost. Yeah, I didn't think of that it would renegotiate the whole terms of the first mortgage.
Yep. It's a whole new loan, a whole new process. Whenever you refinance, we still have to pull your credit. You still got to get 2 years of taxes. We need recent pay stubs for you, W-2s, bank statements, picture of your ID, the whole litany of checklist that we need for documentation. It's a full mortgage process.
Yeah.
So yeah, it's a new loan. It could be a new lender, it could be new interest rate, new term.
Okay.
But yeah, you're resetting the time frame.
Gotcha. Is there a way to consolidate? So say you do the cash out refinance, you buy another investment property, then you want to consolidate those two mortgages into one. Is that possible?
If you have the equity on one of the properties, yes.
Okay.
So
As to be like 20% of the whole cost?
Yeah, so we can go a little higher, but you're going to have PMI on that loan, the mortgage insurance. Anytime you have less than 20% equity, you're going to have mortgage insurance.
Okay.
What mortgage insurance is it's an insurance policy that we as the bank, it covers our butt, but we make the borrower pay for it.
Right.
So in the event that they default on the loan, there's some security there that will get paid.
Gotcha.
So PMI, private mortgage insurance, it's based on, there's a few factors that go into the cost. And they're all revolve around risk. What's your credit score? If you have a better credit score, historically, you're bound to make your payments.
Mm-hmm.
If you have a lower credit score because maybe you have some collections or you haven't paid on time, it's a riskier loan.
Right.
So your credit score is one factor that goes to the PMI cost, as well as how close are you to the threshold of 20% equity.
Okay.
Are you doing a 5% down purchase, or are you putting 15%? If you're putting 15% down, you're pretty close to that 20% threshold. So the PMI cost isn't going to cost as much.
Right.
Because they're not covering as much.
Okay.
And then the third factor is loan amount and by default payment. So if you're buying a house that's $800,000 with a monthly payment of $6,000 compared to a $300,000 house with a monthly payment of $1,500, or I'm just throwing numbers out there.
Yeah.
If you lost your job and you were out of work for a month and a half, it'd be harder for you to make up those payments at $8,000 a month,
right,
as opposed to making the payments at $1,500 a month.
Right.
So, cost of how close you are to the threshold, your credit score, and the loan amount size, because ultimately that's what they're insuring.
Okay.
So,
is there a way to get around that PMI, like a piggyback loan? I think I saw, or something like that.
So you can do that. You can do prepaid mortgage interest up front.
Okay.
So if you want to pay for it all in one lump sum and have monster down closing costs up front, you can do it.
For the PMI?
Correct. Prepayment.
Huh.
I wouldn't normally recommend it because today's day and age, houses are not cheap. They're expensive.
Yeah.
And so people are really pushing their threshold for affordability. The last thing they need is to have even more money up front because they're already putting a bunch of money down for acquisition.
Yeah, why wouldn't they just put the 20% down if they're going to put money down for the PMI?
Correct.
Right. What's like an average PMI, would you say, for like a house? It's all different?
Yeah. So I've seen it as low as $30 a month.
Okay.
And I've seen it $400 a month.
Ooh.
Yeah. So, and it all depending on the risk factors. So if you're a first-time home buyer and you're looking to maybe start buying this spring, this summer, and you don't have a ton of money saved, that's okay. Don't get hung up on the PMI cost, because PMI could be $50 a month. But if you're trying to save for 20% down, it could take you 3 or 4 years to save for 20% down. So just scrounge up what you've got now and pay the PMI. Because $50 a month isn't that great of a cost in the grand scheme of things if it means you can buy a house now as opposed to having to wait 4 years.
Right. So most loans charge the interest up front for the first couple of years.
Yep.
Is there any that are like adjustable rate mortgage loans and stuff like that?
Yep. So with a fixed, so there's two main loans when you're talking, like the two buckets. Mortgage loans have two buckets. You've got a fixed rate and you've got an adjustable rate. Adjustable rate mortgage, we call it an ARM in the industry. ARM, just short for adjustable rate mortgage.
Yeah.
So if you go with a fixed rate, you say, hey, Tony, interest rate is very important to me. I want the lowest monthly payment possible. So we put you on a, servicing released loan, and we sell that loan to an investor, and we can get you 6% or 8%, whatever that interest rate is. It's locked in for 30 years. So that way, if you never touch the loan again, that's your interest rate for the next 30 years.
Okay.
An adjustable rate mortgage has a few different caveats to it. Let's say 5-year and a 7-year ARM, 5-year adjustable rate mortgage and a 7-year adjustable rate mortgage. Both of those loan options, they're still a 30-year term. But what the adjustable part comes into play is you've got a fixed interest rate for the first 5 years or 7 years. After that, interest rate can adjust based on the market. So it can go up, could go down, but it can go up. I think 2% in one adjustment.
Okay.
So if you're used to having a 5.75 and interest rates go up like they are right now, people that are after their 5-year fixed period and now they're in that adjustment period, they could wake up tomorrow and their interest rate would be from 5.75 to 7.75.
Right.
And now the caveat to that is the ARM product follows the market. So you probably wouldn't get that much better of an interest rate if you were to refinance and put it into a fixed at that time. But at least you don't have to wake up and have it adjust on you.
Gotcha.
Fixed rate for that term. So let's talk about the reasons why someone might do an ARM.
Right.
So that would be advantageous if this is your starter house. Maybe you're going to grad school and you're only going to be here for 2 years and you don't want to pay someone else's mortgage payment by renting from someone. If you can qualify, buy your own house. Typically, an adjustable rate mortgage is going to have a better interest rate.
Up front?
Correct.
Okay.
And that's what makes them attractive. Because instead of having, let's say, a 7% interest rate, we can get you a 6.5% if you take the adjustable rate mortgage. The adjustable rate mortgage is going to be fixed for 5 years. So who cares what happens year 6?
Because you're going to be getting out of there in 2 years anyway.
You're not going to own the house in 6 years. At least that's your initial game plan.
Right.
So a lot of people, I think the average person stays in their first house for 3 years. Don't quote me on that, but I think that's pretty accurate.
Yeah.
A lot of people are like, well, give me the lowest interest rate. And that might be, it's an ARM, an adjustable rate mortgage. If you end up staying year 5, okay, let's have a conversation. Maybe it's time to refinance you into a fixed rate.
Or do you want to an option? Yeah.
Correct. Or do you want to just ride the market and see what happens? But if you're only going to stay in the house for 2 or 3 years, give me the best interest rate, because who cares what happens in year 6, because I'm not there.
Right.
I'll have sold the house and paid off that loan and on to the next one.
Huh. Is that a smart idea to do, though, with like closing costs and stuff, to buy a house instead of rent? If you're only going to be there for like a year or 2?
Yeah.
Really?
With appreciation. So the thing is I wouldn't do it if you were buying a house that was turnkey.
Okay.
And what I mean by that is a house that's brand new, shiny, renovated. We'll use the word flipper. It has a negative connotation, but maybe a house that was recently flipped, which means they took a dated property and they renovated it. They did new flooring, new bathrooms, new kitchen, and made it work more.
Right.
If you're going to buy one of those properties and you're paying top dollar for it, it's going to be tough to get your money back when you go to sell it in a year. The reason being is because now when you're a seller, not a buyer, sellers typically have to pay for the realtor commissions.
Right.
So that being said, if you're paying 5 or 6% off of your $300,000 sale price, that's $15,000 right there. $18,000. So you've got to hope and pray that either you did enough remodeling to make it work more, or maybe you paid it down, or just standard appreciation on that property, because now you've got to pay for the realtor commissions.
Right.
There's also transfer taxes and closing costs as a seller as well. So if you're going to buy a house, live in it for a year or 2, buy one that needs some work. So you can create some value, some equity add, and that way when you go to sell it, you won't be upside down.
Okay. Gotcha. So it'd be recommended to go into a fixer-upper kind of house.
100%.
Instead of the fixed-up shiny one already.
Yes.
Gotcha.
Yes.
How would it work? I know some people could do, like, for example, you buy a car and you need to finance it, or you already have a loan on that boat. Let's say you have a loan on a boat and you have a mortgage on a house. Can you consolidate the 2 loans together into one?
Yep. So with a cash out refinance, you can do whatever you want with the money, as long as you've got the equity there. So when I pull your credit report, I'm going to see your mortgage, your Capital One credit card, your Bank of America credit card, maybe your car loan with Chrysler Financial, and your boat loan.
Okay, so it'd be considered a cash out refinance. So you'd be using the equity you have in the house to pay for the boat.
Yes.
And then, okay.
So then at closing, we're going to say, okay, get payoff statements for your car, for your boat, for your credit card, if that's your goal, to pay everything off and have one payment. And you get account statements or payoff statements. And at closing, we cut checks. We say Chrysler Capital, $34,000. Student loans, $12,000.
Right.
So that's one option to do it. But I always have the conversation with people. Does that make sense? Right now, if you keep doing what you're doing on your car loan, you'll be paid off in 5 years. If we wrap that into your mortgage because you're drowning in debt, you're technically taking that $30,000. Instead of being done in 5 years, you're putting it on a 30-year loan.
Right.
So it's costing you a lot more. For some people, they're in dire needs, and that's just what they've got to do.
Or if the rate's super good at the time.
Correct. Like if we're 3 years ago and it's 3% rate, car loans were low as well at that point, but for whatever reason, maybe it wasn't, that could make sense too.
Right. Can we walk through kind of like a step-by-step process of if somebody comes due and is looking to buy a house, kind of what they go through?
Yeah. So come to me first. A lot of people, they window shop, they look on Zillow, they fall in love with properties, and they say, Tony, we love this one. I want to buy it. That puts the pressure on me that I've got to get everything done basically that day, because houses aren't on the market long. And it's a tough conversation if you fall in love with a house and then I'd say I can't get you approved for it because it's out of budget.
Right.
So come to me first and we'll have a conversation around, have you been looking online? What have you been falling in love with? Has it been 350 or 600,000? What's that? What houses can you see yourself living in?
Yeah.
And then let's talk about the payment that comes with that. And then A, are you comfortable with it? And B, do you want it for your mortgage payment? So I like to meet with clients first and just have those conversations, and because you don't think about it unless someone brings it up.
Right.
So I'm going to say, hey, let's look at the big picture here. Then once we meet, it can be on phone, Zoom, in person, email, whatever you're comfortable with. I'm going to ask you for a list of documents, and it's going to be 2 years of your tax returns.
Okay.
2 years of your W-2. If you're self-employed, I'll need 2 years of your business tax returns as well. A valid ID, 2 months of bank statements, or where you're going to pull the money from for your down payment, and then a month of pay stubs, if I did say that.
Okay.
So we need all those documents. I email you a link, and the application process is super slick. So I'll email you a link. You click on it. You put in your information about where you live, where you work, how much you make, date of birth, social, all the litany of annoying questions that you would have to assume you'd be applying for a mortgage. So you fill out the application. As soon as you're done, I get an email.
Mm-hmm.
Hey, Hunter, fill out his application. Great. Then I go into the application, and that's what will involve a credit pull. It's going to be a hard pull on your credit report because we have to figure out if you're, viable or, qualifiable to get a mortgage.
Mm-hmm.
For most mortgage loans, if you've got above a 640 credit score, you'll be fine.
Really? I feel like that's a pretty low credit score.
Mm-hmm. So I've got programs where we can go even lower.
Wow.
580. But yeah, if you're above a 640, typically you're financeable. Okay. It just depends on if we can get you approved for what you're looking for as far as the monthly payment. Because I might be able to get you approved for 200, and you might say, well, Tony, the only thing I've been liking has been 300.
Yeah.
It's like, okay, well, we either have to have an adjustment on our needs versus wants.
Yeah.
Or we got to come up with some more money somehow.
Mm-hmm.
So how do we do that? But yeah, so once you apply online, I get the notification. I go on the application. I'm going to pull your credit, and I send that to all my clients because you're not going to know what's on your credit score unless someone like me sends it to you.
Mm-hmm.
So like people are like, well, I've got Credit Karma or Credit Wise. Those are great credit monitoring tools, but they don't look at all factors of your credit. They're only looking at 2 of the 3 credit bureaus where I'm able to see all 3, and I get to see your actual score. They get to look at factors of your score, and they can get a decent idea of where your credit score is at, but it's not going to be concrete.
Right.
I've had people come to me and say their Credit Karma says they're 810. I pull their credit and they're 740.
Oh, wow.
I've had people come to me and they say I think I'm 640, Tony. I don't know. I pull their credit and they're 700. So I've seen major swings. So it is a good tool to kind of see where you're at, but you won't truly know until someone like me pulls your credit.
Okay.
I share that credit report with you so that way you know what's on there, because otherwise you would have no idea. And then I talk you through it. I say, hey, here's what's on your credit. Maybe there's some good stuff. Maybe there's some bad stuff. Like, oh, that dental bill I forgot about. Or when I switched from Verizon to US Cellular, I forgot to pay my last month and now it's a collection. So then we can see if, I'll explain the good things and the bad things on your credit report. And maybe you're not ready right now, but how do we get you ready?
Yeah.
So I'll say, hey, here's a blueprint to follow. I need you to pay off this, this, and this. And, get this collection off your report and maybe become an authorized user on a family member's credit card. So I'll strategize with you to get you ready if you aren't right now.
Okay.
After you apply, I'll go through the credit report with you. Just education. Education's huge in my job. I want to make certain that you know what you're getting into and there's no surprises.
Yeah.
So once you've got all the documents to me, I've pulled your credit, then I run it through underwriting, and underwriting will ultimately say green light go or can't get you approved. If I can green light go, then I give you what's called an approval letter. That says, hey, I'm qualified to buy a house. It's a pre-approval letter. So whenever you meet with a realtor, you give them your pre-approval letter and say, hey, I'm qualified to buy. A lot of realtors in the industry, they won't give you the time of day if you don't have an approval letter. Otherwise, you're just a window shopper.
Yeah.
You're not qualified to buy. And in this market, you need to be qualified to buy. So pre-approval comes first. Once you're pre-approved and you know what you're approved for, then you can start the house search. Because if you find something you love, you got to act fast.
Right.
Otherwise, by the time you call me and we go through the process and I pull your credit and you get all the documents to me, that house is probably going to be sold.
Right.
So come to me first. We'll get you pre-approved. Once you know what your budget is and what you can afford, get you connected with a realtor. I've got a bunch in my circle that I trust. They'll start showing you houses. Once you find one that you love, you submit what's called an offer to purchase. That's an offer to buy a house. On there, your realtor is also going to submit my approval letter. It's going to say, hey, I want to buy your house. And by the way, I'm approved to buy it.
Okay.
I'm not just a window shopper.
Right.
Those things in tandem get submitted to the sellers. The selling realtor, their job is to present all offers to the people that own the house. Say, hey, we got 3 offers. This person's from a local bank. This person's all cash. And this person has to sell their house first before they can buy your house. Then it's the realtor's job just to educate the sellers, their clients, saying, hey, we've got 3 strong offers. This one, they got to sell their house first, so it might take a little bit of time. This person's all cash. They can close in 2 weeks. This person's using a local bank, but I know that guy. I know he'll get it to closing. So it's their job to educate the sellers, and the sellers can say, well, ultimately, I don't mind waiting a little bit more because they were going to pay us more money. Or we already found that next house I want to buy. I need my money in 2 or 3 weeks.
Right.
Or I know that guy. I know he's going to get it to the closing table. It's a strong offer, and he can get it done in 3 weeks or 4 weeks.
Gotcha.
So every offer is going to have different variables that are more enticing to that seller. It just depends what's important to the seller at that time. Are they selling because they want to move across country for a new job, or because family passed away and they want to get closer to home, or they're ready to move up to the next bigger house? So every seller is going to have their own motivating factors, and ultimately that's why they're selling their house. So
Gotcha. And what fees could somebody expect from like a loan officer right out of the get-go?
no fees.
No fees.
No fees. So it doesn't cost you anything to get pre-approved.
Gotcha.
It only costs you something when you buy a house.
Okay. So at the closing table.
Correct. So you've got your down payment, and then in addition to your down payment, you've got your closing costs. Closing costs are typically a couple $1,000s.
For the buyer as well?
Just for the buyer.
Okay. And for the seller, it's
for the seller,
because they have to pay the realtor fees as well.
Yeah. So the seller's got to pay the realtor fees, right now at least. And then they also have to pay a transfer tax.
Okay.
So and it's a state of Wisconsin thing. Whenever you're transferring the title of the property, it's based on I think it's $3 per thousand of sale price.
Okay.
So there's an added cost that the seller has to pay for transferring title to the new owner.
Gotcha.
And then they also typically will pay your prorated water bill, because that's a quarterly statement. And if you lived in, or you were using the water for 3 months and that water bill's coming due the following month, they'll give you some prorations for their water usage.
Okay.
Now that's probably getting a lot more granular than most people would care to know, but and then additional costs is on top of the realtors. They got to probably pay off a loan. Maybe they bought it for $250. They lived in it for 5 years. It's not paid off probably. They probably still owe $210.
Right.
So now they got to pay off the mortgage.
Gotcha. So that all takes time too.
Correct. So that's all taken care of with us and with the title company. So that way, when you get to closing as a seller, how much money you're going to net, how much money am I going to put in my bank account after I've paid everything. And then as a buyer, on your closing statement, you'll see cost of the house, closing costs, establishing an escrow account, which is basically, think of it like a separate savings account for your house.
Okay.
And it's for the property taxes. So that way, at the end of the year, when the city sends you a bill and says, hey, your tax bill is due for $5,000, you don't have to scramble and find it. You've been having a higher monthly payment methodically.
Okay.
Where the bank puts that money in a separate account. It's still your money, but we're strategically putting it there so that way at the end of the year, there's enough money there to pay that bill.
So it spills over.
Correct. So you don't have to scramble and come up with $5,000. You've been paying an extra $400 a month, and we've been putting it in an account for you.
Gotcha.
Yep.
Do you guys do that with every single one pretty much?
So you don't have to, but we like to.
Right.
The reason being is because if we can control making certain that the property taxes get paid, it's less risky.
Okay.
Because people, someone might say, I don't want to establish an escrow account. It's like, okay, well, it's a riskier loan, so your interest rate's going to be higher.
Oh, really?
Yes, because it's an added layer.
Huh.
Because if you become delinquent on your property tax bill, you're making the payments, but it's not your house until it's paid off. It's the bank's. We own it.
Yeah.
So if you're not taking care of the property taxes, it's riskier for us.
Right.
So pretty much everyone, unless you exclusively request not to be, we're going to give you an escrow account.
Okay.
It's safer for everyone, and that way, tax time comes December. That's also Christmas time. If you overspend on Christmas gifts, now you don't have the tax bill money.
Yeah.
So it's an added little layer there, and probably a nuance, but so we don't escrow for your homeowner's insurance. In my past 2 banks, we did. There's a reason behind it, because people frequently change insurance companies. Every year, hey, my renewal came up, it went up, I'm going to shop. I'm going to go to Allstate, State Farm, American Family. We always have to have proof of insurance on a property. So we need to have the loan number, PyraMax Bank as a lien holder or mortgagee. And if you're changing every year, it's a lot of paperwork for us.
Okay.
You got to remember to let us know. And if you don't, we've got a third-party service to make certain that we're listed on properties, and all of a sudden, if that policy isn't active, because that's a number we were following, because you went from State Farm to Allstate, now we got to say, hey, send you a letter, hey, do you still have insurance? Make sure you have it. What's the new company? What's the new policy number? And it was a lot of paperwork, and everyone just didn't like doing it.
Yeah.
So to make it more streamlined, we just escrow for the insurance, or for the property taxes. You take care of the homeowner insurance.
Right.
So on top of your closing cost, they're typically a couple $1,000. within that $2,000 is paying for an appraisal. It's about $450.
Okay.
Beyond that, you've got title work. Title work confirms that essentially you can buy that house. There's no mechanic liens on it. There's no encroachments or easements that you would know about, but also that the bank can put their lien on the property, that there isn't any other liens on the property.
Okay.
So you've got title work in there as well as a cost. We have an origination fee, which can vary based on if we're keeping the loan in-house or if we're selling it. So you've got about $2,000, $2,200 in closing cost, and those can vary based on product, things like that, but typically about a couple grand. And then we establish what's called the escrow account for you, that separate savings account.
Okay.
We want to put a 2-month cushion in there. The reason being is, let's say property taxes trend upward. They don't typically get cheaper. So if your tax bill is $4,000 this year, next year it might be $4,200. We put a 2-month cushion in your escrow account because at the end of the year, when the city issues their tax bills, if we were planning for $4,000 and now it went up to $4,200, we're short. We don't want to have to come back to our clients and say, hey, we're short money. You got to bring money to the
Transfer
table.
money to that account.
Correct. So we put a 2-month cushion in there for that case.
Okay.
If property taxes do increase, we've got at least 2 months worth of cushion there where we can still cut that check.
Gotcha. So as the buyer, expect to pay for the down payment, which could be 20%. Then you'd go with $2,000 for like the titling, probably.
Yep.
Does that matter how much the house cost?
No, it's
pretty solid.
Yeah.
$2,000.
Yeah. So if you're doing new construction, costs are more.
Okay.
Because there's more variables involved with the new construction house. But for your standard first-time home buyer, refinance, moving up, second home, about a couple grand.
Gotcha. So refinances, you pay a couple grand as well.
You can put that in the loan.
Okay.
Still a cost.
But it is still a cost to refinance.
If you want to pay it up front, so it's not financed over the next 20 or 30 years, you can do it.
Right.
But a lot of people are like, just put it in a loan.
Gotcha.
And so with down payment, you might not need 20% down. You can do 3.5% down with what's called an FHA loan, or you can do 5% down with conventional financing. There's other products out there where you can do little to no money down if you qualify for grants, first-time homebuyer programs. So there's a whole litany of loan programs. It's just my job as a lender to find the best one for you.
Right.
And best one could mean different things for different people.
Okay.
I don't have a lot of money. I don't make a lot of money, but I want to buy a house. Let's get you qualified for all the grants we can.
Interesting.
If you are, if you're looking for the best interest rate, okay, let's go there. If you are looking for an investment property with the best interest rate, because ultimately that affects your bottom line, okay, let's go here. So it's my job to find the right product for you.
Okay.
But yeah, so then you've got your closing costs, establishing that escrow account, which could be a couple months, and then your down payment.
Okay. So then that escrow account, I would say maybe like $2,000 or something you put in it up front?
Yeah, could be.
Okay. So yeah, $2,000 for the titling, $2,000 for the escrow account, and then whatever your down payment is, those are the upfront costs for the buyer.
There's actually 2 more that I'll tell you about. So the appraisal was in that $2,000, but technically that's an upfront cost to you.
Okay.
You pay that once you get an accepted offer, because now the bank wants to find out what's the house worth.
Right.
Is it worth what you're willing to pay for it? So that's when it's like $450. So you would pay for an appraisal. That's $450 up front. The other cost is your homeowner's insurance, because we don't escrow for it, because people would change all the time. So a year paid homeowner insurance up front.
That's what you'd pay at the closing as well?
Before. So when you reach out to your insurance agent and you say, hey, I'm buying a house in 2 weeks, and they're going to say, congrats, what's the closing date? What's the property address? How much are you paying for it? And they're going to say, how many bedrooms, how many baths, all those factors that go into homeowner insurance. And then you're ultimately going to pay first years of homeowner insurance, and they're going to give you a paid receipt. So they're going to send us the binder, which is proof of homeowner insurance, and the paid receipt. So that's an upfront cost to you. It won't be part of my closing, but it's still a cost to you.
Okay.
So that can be paid on a credit card.
Gotcha.
Same with the appraisal. So the appraisal is $450. Put it on a credit card. Get the points.
Okay.
Same with the homeowner insurance. Now, let's say after 1 year, if you would prefer to have that homeowner's insurance monthly instead of getting a bill for another $1,500 in a year, you can switch it at that time to be monthly or quarterly, or keep it on the annual pay schedule with whatever your insurance company offers. Gotcha.
Would anything change if it was a private sale where you knew the person, they're like, hey, we'll give you a deal, $200K, would you still have to get an appraisal and everything like that?
So The system will tell us.
Okay.
It's an automated system that's very smart, and it looks at the property address. It can instantly pull in previous sales, comps, values, like everything, and it will tell us if we need an appraisal or not.
Okay.
You could have the opportunity to get what's called an appraisal waiver, where the system says that we're fine with that. You don't have to pay for one or a limited cost, but most times it will be a full appraisal. Now let's say you're buying the house from your friend, you're getting a good deal. And on your offer to purchase, you say you don't have the appraisal contingency checked. So what an appraisal contingency is I'm willing to pay X for this house based on the appraisal coming back.
If it checks out, or the value of it?
If the appraisal value checks out.
The value, okay.
Correct. So you could not have that box checked, but the bank is still going to require an appraisal. Just because the borrower's fine with not getting one, the bank still has to be confident that the house is worth what you're willing to pay. Okay. So no matter what, if that box is checked or not, we're still going to require an appraisal. But if that box is not checked, that means you can't negotiate. So if you have an appraisal contingency, that means you can negotiate based on the appraisal.
Gotcha.
If it's not checked, can't negotiate.
Okay.
So let's play that out a little bit. So let's say you're willing to pay $250 for a house. We order the appraisal and it's worth $300. Great. You don't have to pay more for the house now. That just means you're getting a good deal. Yeah. And once you close, you've got $50,000 in equity because the appraiser just said this house is worth $300. Flip side of the coin, let's say you get the appraisal, you're paying $250. Appraisal comes back $240. $10,000 difference than what you were willing to pay at $250. If it's that box is checked on the offer, now you can go back to the sellers and say, hey, we had the appraisal contingency checked. Can we renegotiate? Otherwise, that's your out. If they don't want to negotiate, you can say, okay, well, not worth it. Yeah, I'm going to walk away. But let's say it comes in low at $240 and you did not have the appraisal contingency box checked, so you can't negotiate on it. You as a buyer, you got to come up with the difference. So you have an additional $10,000 to come up with. Really? Yes, because the bank...
Oh, right, yeah, because you're already committed to it.
Correct, and the bank is not going to make up the difference. Right. So you've got to have the... Now, that's not very common, but you see that a little bit when it's a competitive market and buyers are willing to ultimately do whatever. They're going to waive the contingencies. You hear that a lot. They're going to waive the appraisal contingency. They're going to waive a financing contingency, which if they're financing it, you should never do that. Or waive an inspection contingency. Okay. So if you waive an inspection contingency, that means you can't negotiate based on the inspection. Right. If it's checked, you can get, like, if you pay for an inspector and he's like, dude, this foundation's going to crumble, you can run if you have the box checked. Right. If you don't, because you're like, nope, want this house, you can still have an inspection. Sometimes they won't let you because you didn't say you were going to negotiate on it. It wasn't checked. But you can not check the box saying you can't negotiate on it, but I still want to get one just so I know what I'm getting into. Right. So you as a buyer, that's your opportunity to still pay for one. Now, sometimes the sellers might say, well, it's not a part of our contract, so I'm not going to let you in the house until closing. But it's an option. Gotcha. And so the bank always has to get an appraisal? Correct. We want to make sure that the investment's worthwhile. Right. And do you show that person even if they didn't have it checked, or do they not get to see it if they didn't check the box? So as a seller, you don't get to see our appraisal. Okay. You didn't pay for it. You didn't order it. It's not for you. Same with buyer? Buyer always gets to see it. Oh, buyer always gets to see it. That's their right. Yep, that's their right. So buyer pays for it. We order it. You don't get to call your friend that's an appraiser. We order it. A third-party service takes care of it for us that's not interested in getting the deal done. Because if you call your friend, you're going to say, hey, have it come in high. Yeah. This appraiser. Or me as a lender would say, hey, I can't have this deal fall apart. Make it come in strong. You know, that's not how I would, I have an incentive to get the house closed. So we order it through a third-party service. It goes round robin. If you're the next appraiser in line in that area that you service, you're the appraiser for it. Okay. But once we get the appraisal back, we as the bank, obviously we get it because we want to make certain it's a good investment, but we always send it to the clients. So that way they know what they're getting into. Gotcha. That's now an appraisal's separate from an inspection. Okay. A home inspector, he's going to go out there, climb on the roof, check the gutters, open and close the windows. He's going to go in the basement and pop off the cover on your furnace. He's going to go through that house with a fine-tooth comb, and his job is to find everything that's right with it and everything that's wrong with it.
Okay.
So I think home inspectors are normally in a house for 3 hours.
Oh, wow.
So they're checking every door, every lock, every sink, hot water, cold water. Like, they are going through that house with a fine-tooth comb. So that way, once you pay for an appraisal or an inspection, you know exactly what you're getting. And he's going to say, hey, the roof is fine. There's no leaks, but it's going to need to be replaced in 3 years.
Right.
Or I noticed this was incorrect on the water heater. So the appraiser or the inspector is going to go through that house with a fine-tooth comb and find everything that's right and everything's wrong.
Gotcha.
The appraiser, that's not his job to open and close every window. He's looking at the structure itself. So he's going to say, okay, it's an 1,800 square foot house. It's a ranch, 3 bedrooms, 2 bathrooms, an attached 2-car garage. He's looking at all those line items. Because ultimately what he's going to do is he's going to say, okay, this is what this house looks like, the level of finishes, the location, the size of the yard, the square footage of the house, beds, baths. And then he's going to go look for comps. A comp's a comparable. He's going to look for other homes in that similar city, neighborhood, and street that have recently sold. And he's going to go off of those comps, whether they're a nicer property or a lesser property, just to get a good idea of what the value of that house is.
Right.
Because the market will tell you what the house is worth. If the house sold for $280, it's worth $280 because someone was willing to pay $280 for it.
Right.
So he's going to pull comps in the area to figure out, if you had to list this house today, here's what it's worth.
Right. And would that appraisal go in before you make an offer, or is it after the offer?
After. So after an offer, because there's a cost associated with that. So you wait until you've got an accepted offer.
Okay.
Typically, once you've got an accepted offer, because most buyers are not going to be home inspectors. They're not going to, unless they're a general contractor, they're really not going to know exactly what to look for. Like, at face value, it looks like a great house, but let's have someone that's licensed go in there and confirm. So once you get an accepted offer, that's where you can order the home inspection, and we'll order the appraisal, and we'll order the title work, all of those check marks after you've got an accepted offer.
Gotcha. So the bank cares about the home inspection as well?
No.
Oh, you guys don't care about that? Just
Correct.
The buyer?
Correct. Only the buyer. We care about the appraisal. Now, let's play that out. So let's say the appraisal comes back and he calls out that there's water in the basement, and he'll take a picture or two. If there's water in the basement, that's our opportunity as the financer to say, hey, you need to have a licensed basement specialist go in the basement and figure out what's wrong with this.
Okay.
Because ultimately it's our debt that we're buying it with, so we want to make sure that it's not going to collapse or that it's safe to live in.
Yeah, right.
Essentially, they're looking for the structural integrity of it.
Okay.
Safety and soundness of the property. So if anything that affects the structure, like for instance, if you've got a second floor balcony and there's no railing, that's a safety issue.
Okay.
So they would say, hey, you got to put a railing on that before we can close and take ownership of that.
Would that be only if they check that box for the being able to negotiate with the home inspection?
Well, that would boil down to the financing contingency. Because the bank won't do the loan unless we're happy with it.
Okay.
And ultimately, we would want to be happy with it so we can sell it.
Okay. Because
we know that if someone else does a drive-by and they see a second floor, third floor balcony with no railings, it's like, that's a potential lawsuit. Put a railing.
Yeah, right.
But yeah.
But there's little things like, say, like the hot water heater's not working, or like is getting old or something. If you had that box checked as a buyer, you could say like, hey, well, you need that replaced. Or that would be like where the negotiation would come into play.
That's when you can negotiate. Yep. So they might say, you know what? I don't even live in that house anymore. I'll take off $1,500.
Okay.
Or they'll say, okay, yeah, we'll get it fixed.
Gotcha. So if you didn't check that box, that would be if like you're trying to move quick and you don't even care, you just want to get into it right away.
Correct. Right.
Gotcha. Okay.
So yeah, there's a whole bunch of strategy involved with how do we make our offer more attractive to the sellers, but how do we not put ourselves in a pickle?
Yeah.
If we don't have these boxes checked, are we okay with probably the repercussions that come with it? Like if we don't have an inspection contingency and we think we saw everything, and after we own it, the first rain, we get water in the basement. It's like, okay, well, we didn't have an inspection, and he probably would have been able to tell us that there's signs of residue, and he has a moisture meter, and he can hold it to the cinder blocks and say, hey, this is wet. You might have some damp issues. It could be rectified by putting a dehumidifier, or you might have to change the grading in the outside to have water run away from the house, or that side of the roof is missing gutters. Something simple as gutters could solve the problem, or there could be bigger issues with the foundation. So, but yeah, I mean, it's all about how do we have an attractive offer to win in this market, but also how do we protect our buyers?
Gotcha.
And that's more of a realtor's job, not mine. But just seeing enough of these across my desk, I've kind of learned what wins and what won't win, and like just another education piece. Now, I don't want to, like, that's ultimately the realtor's job, is to talk about like inspections and appraisals. But it's my job to also just educate them on how it works from my side of the desk.
Okay.
But they're going to say, hey, this house is pretty clean. I didn't notice any moisture in the basement. Now, if the realtor's been doing this a while, they typically know what to look for.
Okay.
I saw gutters. I saw, the foundation was dry. There was no moisture. There wasn't an active leak in the sink. The flooring wasn't buckled or uneven pitching to one corner. You can typically get a good idea, but it's always nice to pay for an inspection.
Right.
So
for sure. Then you have a peace of mind too.
Correct. Then you know what you're getting into.
Yeah, for sure. All right, well, let's wrap it up with a couple last questions that have really nothing to do with your job, but I feel like they're just like fun questions to ask.
Let's do it.
So let's start with, what was your dream job when you were growing up?
I had two. One, I wanted to be a pro soccer player.
Okay, classic.
Every young kid wants to be an athlete.
Yep. Yeah.
And then once I kind of knew that probably wasn't going to happen, I shifted my mentality and I want to become a chiropractor.
Okay.
So that's what I ultimately went to school for.
Really?
Chiropractor, yeah.
Huh. And now you just got fixed up by one.
And literally saved my life. So if you don't have a chiropractor, get a chiropractor. They're great, yeah.
All right, what's your favorite restaurant in the area?
Oh, man. I'm a big foodie.
Okay.
So I'll go anywhere. I love trying new restaurants, but I'm also a creature of habit. So I live in Milwaukee at there's a few restaurants close to me. The Station, it's right on DuPlainville Road in Milwaukee. Okay. That's like a towny bar spot.
Huh.
Fancier food, Thunder Bay Grill is another good one.
Yeah.
They've got a great lunch special. It's great for networking meetings. But also we've come to love places in downtown Milwaukee as well. So we'll make the drive for a special night out. Elsa's on the Park is in downtown Milwaukee. Or Taco Truck, man.
Yeah.
Taco Truck. That's like, so right down the road from my office, we've got a taco truck.
Okay.
And whenever I work like hybrid, we'll call it.
Okay.
If I'm meeting with someone or just coming to the branch once or twice a week, I'm going to the taco truck.
Really?
Gabriel's Taquiera. It's right down the road. Yeah, it's my favorite spot. But yeah, otherwise I work remote. So
gotcha. What's your dream purchase? Could be a car. Could be a house.
I just did it.
Really?
Yeah. So less than a year ago, my dream car was a Grand Cherokee SRT Jeep.
Oh.
And so I was always looking for one, and it was always just a dream of mine. And I was telling my wife for probably the last 7 years, I was like, I want a Jeep.
Yeah.
Real bad, an SRT. And so I found like literally the dream spec. They only made 129 of them in that color.
Really?
And it was built motor, supercharged, 800 horsepower, on air ride. Just stupid. So that came up and I saw it. It was in the southernmost tip of Florida. So I found it on a Thursday, like 10 o'clock at night. And I showed my wife and she was like, yeah, like, I know that's your favorite car. And I was like, no, I think we got to buy it. She's like, I don't know if we're ready for that. And I was like, nope, we're ready. This is what I want. I've been dreaming about this for 7 years. Like, this is the spec I want. It's got everything I'd want done to it, and it's a good price. So she's like, why don't you just sleep on it? So I messaged the guy and I was like, hey, is it still available? And he was like, well, I've already got one offer. If you want to pay more, I won't turn it down. And I was like, I'll pay more. I was like, I'll give you an extra $1,000 than what the last offer was. And he was like, okay. He's like, I'll tell the other guy it's reserved. It's yours. And I was like, okay, just one more thing. I want to video call you before I agree to this and show me the clean title, do a walk around of the vehicle, start it. I want to see no check engine lights, like show me any imperfections, all that stuff. So he's like, okay, not a problem. So then he was like, well, I'll just call you in the morning. We'll FaceTime. So my wife also was like, we need to sleep on this. Like, this is super impulsive. So then we went to bed. I could not sleep. I was so excited about it because I'm a big car guy.
Yeah.
And I woke up and I was like, yeah, I want that car. So then he videoed me and he showed me everything, and I was like, yeah, it all checks out. And I was like, all right, I'm going to get on a plane today and I'll fly down there. I'll be down there this afternoon. And he was like, all right, sounds good. So he was a pilot. So he was like, send me your flight number once I had it booked. So I had a closing in the morning. I went to the closing, and then my wife waited in the parking lot, and then we already had our bags packed. So after the closing, we hopped in the truck and drove down to Chicago.
Okay.
And that's another long story. But so then we hopped on a plane from Chicago, flew down to the southernmost part of Florida, and he was a flight, so he tracked our flight, or he wasn't a pilot, so he tracked our flight and met us at the airport. And he came in the Jeep, and I was like, wow, dude, I was like, yeah, I want this car. So then he was so nice. He drove us to our hotel. And by that point, it was Friday evening, like 9 o'clock at night by the time we got in there. And so he was like, well, I don't want to have to do this at nighttime. He's like, I'll just drop you off at your hotel. I'll come back in the morning, and you can see it in daylight, test drive it, do all that stuff. And so that's what he did. He dropped us off at the hotel. We slept in the hotel Friday night, and then Saturday morning about 9 a.m., he showed up at the hotel. And I saw it, and I was like, yeah, I want this thing. So that's when I gave him the check, and we drove home from the southernmost tip of Florida all the way back up to Wisconsin.
Wow. And you still like it?
Oh, I love it, man.
Yeah?
It's fun. Yeah.
That's sick.
It makes me smile.
That's awesome. All right. What's the most interesting deal that you worked on?
Oh. They always blow my mind. I don't have one. I have a few. Okay. But we'll just put it in the umbrella. I work with a lot of investors in the area, some out of state, some in state, where they're acquiring properties based off of numbers and based off of trusting the realtor that showed the house, but they've never actually stepped foot in the property.
So seeing buyers.
Yes. So we'll go to closing, and they'll be bringing a check for closing, and they've still never seen the property.
Really?
And it's like, how can you put 30 grand, 50 grand down, 80 grand down, and you haven't even seen it?
That's crazy.
Yeah. So it comes from a strong relationship with realtors, and I've had, I probably get 2 or 3 a year where the person's never seen the property.
Wow.
Yeah. And that's always like, I couldn't imagine.
Yeah.
Like if I'm buying a house, I want to walk in there and make sure that like it doesn't smell like cat pee, or like that the previous owner didn't like chain smoke in the living room. Right. Like there's just things that I would not be comfortable with in buying a house. I didn't see probably not one of them, but that always blows my mind. What else? What was it? Most unique? What was the?
Yeah, most interesting.
So not buying a house without seeing it. That's crazy.
Yeah.
I loved the new constructions because you get to work with that client hand in hand from start to finish. So you can have a conversation with a client and they say, they're a big golfer. And if they're building their dream home, they're going to put a golf simulator in it. Right. And it's like, or they've got 3 kids and they want to do a basketball court in the basement. Or, they want to put a pool out back. Yeah. Or they're in a wheelchair, so they're going to have it be a 0 clearance entry in the entire property. Okay. So just like being able to see people's visions come to life, that's always fun, because ultimately I have to see the blueprints and the line items where it says, okay, foundation pouring, 60,000, framing, 45,000. There's a line item breakdown, so I can see what it costs for those features and also the final, because I get to see it on paper, and then once it's built, the appraiser goes back out to confirm that house is what they said it was going to be. Right. And then I get to see the final product. And then ultimately, like, I would say a big chunk of my clients become friends. Like, we'll go have drinks, we'll have over and host. Really cool. So then I get to see the finished product. Yeah. So like the people that buy the first time home buyers that are buying the fixer upper, I get to see it on the appraisal, the initial and the listing pictures, and then they'll have me over in 6 months, and we'll just like have some beers in the backyard, and they'll show me the finished basement or the renovated kitchen, and so my passions have morphed from like big car guy, but home improvement projects are kind of what I love. And so all of my clients, like, now they know that. So like, hey, Tony, like, do you have a connection for countertops? Or like, I know you did this with your house, where'd you buy your tile? Or like, do you have a tree cutting guy? So like what I found is just becoming like the glue in the industry. Like have a connection for a realtor, have a connection for an accountant, have a tree guy, have a stump grinding guy, have a painter, a roofer. So just being able to connect my clients and other professionals in the industry with people that they would work well with and that they could benefit from. That's kind of that's what I love about it.
For sure, being a facilitator.
Yes. Yeah.
That kind of would lead into this next question I'm going to ask, like what advice you'd have for like somebody that's young, just getting into the industry.
Oh man, ask questions. Just be a sponge. Because there's so many people in the industry that want to help, and just stick your hand out and be like, hey, I'm new to this. I've never done this, but I want to learn. And that can go from someone that is a financial advisor to a realtor, to a lender, to a first-time home buyer, whatever you're in. Just ask questions, because I really believe it's all about who you know, not what you know.
Yeah.
Because if you're not strong in something, chances are I or someone in our circle will be friends with someone that's strong in that category. And so I always, I really believe in, I heard, is it Alex Hermosi? He's a big, he was all about like, don't become well-rounded, like sharpen your points. And what he means by that is like getting good at what you're good at, and don't spend time trying to be well-rounded, because there's someone in your circle that's working on sharpening their point in that exact trade.
Yeah.
So it's like, go all in on what you know, and just be friends with people that are good at other things.
Yeah, for sure.
So
awesome. Well, thanks, Matt. That was super fun.